Those who are new to our calls, this is a live conference call featuring Zacks strategists providing their analysis of the latest issues and trends affecting investors, including but not limited to the current issues and trends affecting the market and the economy, both globally and here in the U.S. Our chief equity strategist, John Blank, and Tim Nyland, managing director of Zacks Institutional Services Division, are our panelists on this call. And in today's deep dive into weak inflation, John will tell us what weak inflation actually means for stocks, and Tim will follow up with some additional factors to consider when looking at inflation. So John, as always, let's start with you.
Thanks, Terry. Let's go to my first slide. Okay, so I've got 3 points that I want to make today, and you can use this slide as a reference. First point I want to make is that U.S. markets are basically driven in a bullish way by the poor returns to treasuries. Now, I'm not just speaking about U.S. 10-year treasuries today, which are trading at 2.2% or below. I'm talking about the holding period returns in 2018 and 2019, because as the U.S. Fed raises rates and Mario Draghi pushes down and doesn't let the 10-year treasury get past 2.5%, the holding period returns for U.S. treasuries are looking basically flat to negative. And so that's going to be an additional lift to the market, is that there's going to be even more money trying to get away from the U.S. Treasury market. And I'm also going to make the case that the U.S. Fed's likely to keep rates much lower than people think, because the economy is much weaker in a labor market perspective than they think. And I'm going to get into this concept of unemployment duration. And that word duration is what I want to track you to, not the rate of unemployment, but the duration of time spent in unemployment. So those are the first topics, is just the lift to the U.S. market that I think is going to come from basically the rate market. Second point I want to make is that the global growth that's coming through earnings the last 2 quarters is being led by semiconductors. And if we look at semiconductors more closely, we're going to find the complexity of the global system there that's producing this growth. And I want to make the case that it's the complexity of a global trading system, a trading of knowledge and cluster knowledge and research and sophisticated machinery, that's at the heart of the current growth in globalization, and is actually what's driving the stock market up. It is globalization. So if we get any anti-globalization produce and we actually get trade effects and take it down, it's going to hurt the global economy. That's my biggest risk right now. I'll finish up with weak inflation. It's tied to wages. The big issue here really is wages, and it gets back to this unemployment duration and this semiconductor thing, which is why we're not generating the wage growth that needs to happen to get ourselves into a situation where we're going to get enough inflation to cause this parts 1 and 2 to change. So let's start right ahead and go to the next slide. Okay, so first off, point out one thing. If you look back in the 90s all the way through to 2017, not only was the price earnings multiple higher than it is today, but it was also more variable than it is today. You can see those ranges showing the annual span of change in the price earnings multiple. And it's amazing to look to 2017 to see how little movement in the price earnings multiple has happened. And you can see this is not something that's new. It's going back 5-6 years. Ever since quantitative easing started in 2012, you can see not only has it raised the stock market's price earnings multiple, but it has lowered its volatility. It has really, truly sedated this market. It is a sleepier market. It's not as volatile. And that is a key fact, or 2 key facts of quantitative easing. The other thing I want to point out is the 18.41 or the 17.76 number is totally in line with many of the years in 2002, 3, and 4 even. So this is not to be too concerned with right now. It is high, it is elevated, but at most you're looking at a 10% correction in a year, and that could happen. But again, we're talking about sedation, we're talking about quantitative easing as being the primary driver. That's being shown by the low volatility, and I think that's going to continue. Let's go to the next one. All right, this is the basic point. Again, back to 2012, keep your eyeballs on 2012. When the 10-year treasury started getting down into that 2.1, 2.2% area, this has stayed in place for the last 6 years. So the dominant feature of this bull market is this low treasury rate. And I am taking that chart and going sideways in a range-bound motion for 2018 and 2019. I am calling for basically nothing to range-bound trading between 2.5 and 1.8 on the 10-year treasury, because that's, I think, all that can happen. And that is going to keep the bull running in this really sedated, very drifting motion upwards in the stock market. I'm not calling for a strong bull market, but I am calling for a weak one based on this rate scenario. So let's go to the next slide. All right, here's it is. Again, notice that, yeah, back in 2015 and 2016, we got a 3% return on 10-year treasury notes because you could make that much. That's peanuts, obviously, relative to stocks. But look what's going to happen in 2018 and 2019. It already has happened in 2017. It's getting negative. So the difference between a 3% real return and a negative return is you're losing money. So this is going to spook another whole tranche of returns, seeking people out of treasuries, out of the risk, out into the stock market for the next 2 years, because it's going to get even worse for this type of person. And that's where my bull call rests. Let's go to the next slide. This is what I want to point out. Again, even when the S&P did 1.4% in 2015 and 12% in 2016, it's doing 11% now. You roll those up and average them, you're getting to get at least 6.5% returns on a year. And that's double what a 3% return is, and it's certainly stronger than a negative return. So there's no question stock returns are going to remain the place to look for stock returns. Globally, and the US market is going to be fine. And this is going to still remain something that you have to keep a market weight, at least on US stocks. Next slide. All right, so now I want to turn to a different question that kind of relates to this idea of duration of unemployment. I went back 10 business cycles. Let's go to the next slide. And I took these 10 business cycles all the way back to 1950. So you can count the shaded areas as the troughs when we had recessions. Now, first thing to notice about unemployment duration is it doesn't peak during the recession. It repeats, it kind of tanks about a year, year and a half out. That shows you the lagging element of the unemployment rate. It really lags anywhere from a year to year and a half in terms of its performance. So what you have now in 2017 is really a 2015 labor market, not a 2017 labor market. And that's the first thing I want to point out, is that we're really still kind of in the employment recession kind of feeling to the labor market. It really hasn't recovered from that employment recession period where people kind of held back and kept the economy sideways. The other thing I want to point out is always, if you just go back to 1980 and look at the last 30 years, which is probably the economy that we have today, it used to be 20 to 10 was the motion of a cycle, meaning 20 weeks of average unemployment for a person was normal. Then you get to 10, which is basically 2 or 3 months. So it used to be 4 or 5 months of unemployment, went to 2 or 3 months of unemployment. Now you can see that in 2011 and 12, people are waiting 10 months to find a job, which was extremely high. It was extremely painful. And even now, this long into this bull cycle, 8.5 years in, we're 24.4 weeks. This is still 4.5 weeks off of the 83 high and the 93 high and the 04 high. So my point here is, if you think this takes about, we're looking at 28 to 24 taking us 2 years, so about 2 weeks a year to get down. We aren't going to get back to 20 weeks of unemployment duration for another 2 years. And that means, I think, really fundamentally, we're in a different labor market. And what I think is happening is, I think the training and the skills of a post-internet society is causing such a level of specialization that if you can find the people, great, but if you can't, even if you're looking for people, you're looking for someone specialized. And this just takes a lot longer to find a job, or to find the person you're looking to hold the job. No matter what side you look on, I think this market, the technical skills, the specialization is part of the story here. The other thing I think is that there's 2 markets out there. One for the highly technical people who are probably being sopped up in that 10-week norm that we see in the past. And then there's the rest of people, the restaurant, workers, the service people who don't have those skills. And this market's telling you really that it's a lot softer than you think. But the bottom line is this is not good news for wage growth, which is not good news for GDP growth. But it is good news for quantitative easing and the interest rate cycle to hang in there for a lot longer than you think. Let's go to the next slide. All right, so that's my point. I just want to point out this is the tell. This is the thing. It's no surprise that wage inflation is not moving up, and it's telling me the Fed is likely to keep rates lower for longer. And this business cycle, as long as you think it's been, it's going to get even longer. That's what I call it. One of the longest business cycles you've seen in a long, long time, if not ever. Let's go to the next slide. All right, so let's go back to where the growth is coming from. Again, I want to point you out back to the Infotech growth rates in 2014, fiscal Q2, Q3, Q4. And you can see that when you did 23, 16, and 21, annualized to 17 and 2014. This was when the global economy was coming up and everything was fine. Then remember, we had Draghi move into a much more aggressive quantitative easing. We had the oil price collapse. That sucked the life out of it. You can see that really sucked the life out of the Infotech market. But there is a relationship here between the rest of the world's materials and commodities pricing and the Infotech market. But now you can see we're back to those double-digit numbers that we saw in 2014. That low for 2 years is gone, and that is feeding into the growth rates that you see on the other side, which is the S&P. You really got to focus on Infotech. And as you can see, the last time we did this run of double digits through 2014, we had 5 quarters of strong growth. We're into 2 now. So I think you have at least 3 more, at least through 2017 and into 2018 for Infotech growth. Let's go to the next one. So that's the point. I want to just point out that if you strip out Infotech growth, the EPS of this entire economy would be in the single digits, not the double digits. And all the domestic growth companies, if you're domestically growing, it's less than 8.5. If you've got the exposure internationally, it's 14.5. And this all turns on the big semi names. I threw out 4. One of them is not a semi name, which is Microsoft, but they're in the cloud. Micron, Lam Research, T Connectivity. These are the names. If you want to look on their Zacks system after, they're showing you how this game is played and where the growth really is in terms of specific companies and what they're doing. Let's go to the next slide. So what's going on? Let's take a short detour through the Semiconductor Industry Association, the SIA. And I want to point out that it's researchers, designers, assemblers, and suppliers all over the world. Let's go to the next slide. And these people are in what they call, and I'm using their language, complex, interdependent, highly efficient, productive, and constantly evolving. So this is a very, very dynamic situation. In a typical scenario, there's 4+ countries, 4+ US states, 3 trips around the world, 25,000 miles traveled, 100 days of what's called prime partition testing, and 12 days in transit involved. So again, when you're thinking about trade pacts and all these discussions on NAFTA that are going on right now, this is the scenario. It's so much more complex and dynamic and so much more involved than you can possibly think. This is really what's going on. So double down on globalization, triple down on it, because that's what's really at play here. Let's go to the next slide. Here's an example of just one value chain that came from the SIA. I have Japan, Southern and Northern California, Australia, Malaysia, Taiwan, mainland China, and back to the USA as the model. So it's mainly Asia Pacific focused, but the interactions are from cluster to cluster and from researcher to researcher. And we really don't get into any manufacturing until stage 6. So there's 5 steps before that ever happens. Keep this in mind. This is what is driving the growth rates and the earnings that you're experiencing. This is what's keeping the market up. Let's go to the next slide. That's all I want to point out is Trump trade is not happening. Complex global production is happening. That's the thing to keep your eye on. That's where we're going. Let's go to the next slide. So the last thing I'm going to point out here is the wage growth and the price inflation. All of us, you've heard about this. You know about this. We know on Thursday this week, we're going to get the next inflation rate for the United States for August. 0.3 is in the game. 1.6 year on year. That's not 2% or even close. And here's what's going on. Again, notice that wage growth started tanking in that 2015, 16, 17 period. we are back to some lows that we saw before. So wage growth really, again, as a lagging indicator, is showing us the earnings recession has some wind in the sales of wage growth for a while. So I think what you're seeing here is a lagged effect from the earnings recession into wage growth, and it eventually will turn up, but it might be a couple years before we actually see it. And this is playing out, and you can see that's clearly the case right now. Wage growth is rolling over, it's not rolling up. And if it gets back into anything as being a range trade, it's not going fast up, and that's basically going to keep the Fed on the sidelines, and that's what I want to point out. Let's go to the next slide. So that's my point. Lower rates for longer, that will elevate stocks for longer. I don't want people to think that since we're not getting wage growth that I'm pessimistic on the stock market. I'm not. I think you're building better profit margins because wage growth is so weak. That's good for stocks, but I also think anybody calling for more than 2.5% real GDP growth is kidding themselves, because we're stripping out the income and the strong demand from the worker, and you can't get it as long as there's wage growth this low. Those who are calling 3 and 4% GDP growth rates, we need to see that in wage growth first. That's the way demand and supply works. You got to have the income to create the spending. It's not happening in this environment. Let's go to the next slide. So that's my point. I'm going to hand this off to Tim, but I want to point out the fallacy of thinking here that since we're at a 4% unemployment rate, wages will rise. And to state it like an economist, that scenario is necessary. We do need a tight labor market to get wages up, but it's not sufficient, meaning there needs to be other conditions in place, one of which is to lower the unemployment duration to make it much harder to find, or much easier to find a job, and much quicker to find a job, and much more negotiating leisure to find a job. That'll raise wages. So keep your eye on the ball with these oversimple ideas that, hey, you know what, we're at a low unemployment rate, there's going to be wage inflation. I think you got to think a lot harder than that, and that's my point. So I'll let Tim take over from here, but that's my thoughts on those key strategic factors.
So Tim, what additional factors do you want to weigh in with?
Yeah, thank you, Terry. So go ahead and go to the next slide. It's really hard to talk about equity valuations without looking at the components of the total equity discount rate. And so what we're going to do is we're going to basically start out where we left off from our last call. I got a lot of good feedback on the slide deck last time, so we're going to basically just take it from that point. This is a slide that was lifted directly out of the prior call, and we looked at the components of the total equity discount rate, and they're up on the screen. So top panel, we've got the equity risk premium, we've got the 10-year treasury in the middle, and then the total equity discount rate at the very bottom. Now keep in mind that this is as of 3 months ago. And the idea here is that, you know, we walked away with the conclusion that the decline in the equity risk premium more than offset the increase in the yield of the 10-year treasury. And effectively, what this is telling us is that cash is basically coming off the sidelines in excess of the sales of the U.S. Treasury. So the U.S. Treasury yields are rising, equity risk premium is collapsing, so more and more money is coming out of the risk-free basket of securities being plowed into equities. And because the equity risk premium declined at a faster rate than the U.S. Treasury yield increase, you can see that total equity discount rate on the bottom collapsing. Next slide. Again, another slide from the previous meeting, and I did update it with the time frame from the previous meeting current. But focus your attention right now just on those red lines that I've drawn there, those trend lines. Again, from the last meeting, we concluded that that decline in the TED rate was the reason for that multiple expansion. That's extremely important. So go ahead and move to the next slide. So now we've got a little bit of a red flag. 3 months later, today, we have in fact retraced that total equity discount rate and that equity risk premium to basically post-election. The 10-year is also on the decline. So we're getting right back to, I apologize, pre-election levels. And the implications for this are great. Next slide. in that if you look at the PE multiple on the S&P 500, we basically have not contracted commensurate with that increase in the TED rate. And so we're going to take a look at this a little bit closer. So the next set of slides, we're going to actually utilize the ZRS composite facility to illustrate the relatively thin mega cap leadership that is basically leading the growth of the S&P 500. So we're going to take this on a sector by sector basis, and you're going to see a lot of those same themes that John mentioned earlier playing out. Again, we're looking at an equal weighted sector composites here so that we can actually strip out that mega cap bias. And what you'll actually see is S&P 500 growth from election levels is basically flat. So you can see I've drawn the red line from October of last year to where current levels are this year. Again, on an equal weighted basis, you can see actually FY2 being revised down just a little bit. Next slide. So if we go sector by sector, you can see that we're still in decline on the discretionaries. Next slide. Still a decline on consumer staples, although they have recovered a little bit, still a decline. Next slide. Energy. Okay, no surprise there, energy prices have come down. Financial sectors, we're going to pick on the financial sector a little bit later, but obviously a source of strength here in leadership. Next slide. Okay, healthcare. Next slide. Okay, industrials are a bright spot, obviously. The business cycle has definitely given a boost to the industrial sector. A lot of defense names in here, aerospace leading the charge. Next slide. Tech sector, as John mentioned, this continues to be strong, continues its leadership. Next slide. Okay. Materials, down to flat. Next slide. Telecom. You all know what's going on in this space. A lot of price wars, eroding margins. Next slide. Utilities, pretty much the same story as last time. Okay. Go on to the next slide. So when we talk in terms of inflation, one of the very first places I love to look, just given the fact that we've got so much of an increase in the money supply, is the velocity of money. And this is literally just the rate of exchange of money. And what we did here is I plotted this in a year-over-year percent change in the interactive charting facility in ZRS. And I took a look at even the broadest measure of the velocity of money. So I grabbed all three measures just to see if any of these has really been positive in a meaningful way since the recession. And one thing I'd like to mention here is that this is really the first time we have not had a period of meaningful positive velocity of money in a post-recession growth period. You'll see in, I believe it's 2010 there, that we had a brief period of positive velocity, but that was basically due to low comps at the bottom of the recession, and that quickly normalized to negative velocity in the next year. So again, I think the takeaway here is up on the slide. The continued decline in velocity of money during a period of expansionary monetary policy is in fact a deflationary force, and it's actually contributing to the offsetting of the increase in money supply. If this continues long term, and this just goes along the same lines as John's reasoning for lower for longer, we really need to see velocity of money pick up, really need to get it positive, and it needs to basically sustain those levels for us to get any sort of meaningful levels of inflation. Next slide. For those of you who have not seen the picture, this is the basic chart of the CPI core. Again, this is minus food and energy. You can see where we went from 2015, and there was obviously a lot of optimism there, and being able to sustain those levels year-over-year percent change in CPI over 2% for pretty much all of 2016, and then the subsequent collapse in 2017. And again, just like John mentioned, this is really what has the Fed and others scratching their heads. We've got structural issues in the labor market. It's really the global competition making producers price more aggressively. Also think about the Amazon effects and others. Once these mega conglomerates, you could almost say monopolies, enter the market, they really have a large say in driving prices down for everyone, and that's really contributing to this CPI pressure. So a lot of global competition here, really hitting costs. Next slide. Let's take a look at the components of CPI just briefly to get a good understanding of what's going on here. These are the inflators, and the reason I've got the inflators up here is it's very important to take a look at the rollover in that CPI housing inflator, and that if that continues to roll over, I believe that's got about a 40% weight in this calculation. That's definitely the largest component of CPI is that housing. This covers housing, rent, all that related costs. So if that continues to roll over, and that's the green line that you see there, you know, I would expect the core CPI number to continue falling, and that's definitely not a good thing. So these are your inflators. We'll make this slide deck available to everyone after the call so you can get a little closer look at that. Next slide, please. So these are going to be the deflators. So, you know, this is the usual suspects. This isn't really anything new. These tend to be the deflator contributors to CPI. So nothing new there. Next slide. This is basically a close-up of what's going on with the 10-year. And again, Draghi's comments, and I say on the slide here, or lack thereof, we literally do have a cap in play now, about 2.5% on the 10-year is what we're estimating. As John mentioned too, I mean, this really does contribute to the fact that equities are going to remain the preferred investment. It's low inflation, low interest rate environment. There really is at this point, you know, no better alternative. So let's talk a little bit about, next slide. You know, if we were going to have a market sell-off, right, and it wasn't going to be triggered by some sort of black swan event, you know, where could this likely come from? We would have to see some breakdown in one of our leadership groups to take this group lower, the entire market lower. Next slide. So let's take a look at some spread components. And one of the things that I've found really interesting as I go through these charts daily is what's going on with the yield curve. And what I've done here is I've just literally taken a look at spread components between the 10-year, the 1-year, and the 2-year. And I put the 1 and 2-year up just to see if any of the one tranche was, you know, an anomaly, and they both trending together relative to the 10-year. You can see massive margin compression taking place. Next slide. You know, the issue here is that, you know, like we've been taught that this collapsing spread and the flattening of the yield curve is bad for financial sector via the, you know, net interest margins. You can see it playing out. Next slide. The issue is here that, you know, we've got financial sector earnings revision that just continue to rise. And this is literally, you know, month after month after month, these estimate revisions continue to go up. Next slide. So when we equal weight the financial sector, again, using the composite facility in ZRS, we can do this very easily. You can see that the underlying growth, or I should say multiple expansion, is commensurate with those earnings increases, right? So we've got a nice multiple expansion on the financials. They've been a good source of leadership. Next slide. And then we can take and confirm this by taking a look at the valuation on the price to tangible book basis, and we can see that, in fact, that PE multiple expansion valuation does get confirmed. We see the similar expansion in the price to tangible book metric. Okay. So the current yield curve is flattened relative to the 6-month and 24-month time frame. So just a couple questions I want to leave you guys with. Are the financial sector earnings, you know, reflecting the current interest rate environment? And I guess more importantly would be where we expect interest rates to be even a year or two out. Does it warrant the current valuation expansion that is more or less outpacing earnings growth? Keep in mind that this sector is roughly 14% of the S&P 500. And I want to show you just some evidence on the next slide as to, you know, what we've seen over the last 3 years relative to the price action on the financial sector. This is literally the 10-1 Treasury spread relative to the XLF 1-year percent change, so the ETF of the financials. And you can see that every time we get ahead of this 10-1 spread, and I've got them circled here, we get a collapse in valuation in the financials. And, we've definitely got some optimism baked in here for the financials, and you can see it there from Q1 2017 to the right, that we have not had that mean reversion back to at least the level of the 10-1 Treasury spread. And so, I guess the question is could this be the catalyst for a potential, correction? And I guess, the answer to that would be, absolutely, that weakness in this group could definitely be enough to bring down the remainder of the market. Am I bullish long term? Absolutely. I think that as you've seen here in Q2 2015, Q3 2016, I mean these sorts of corrections are healthy, they're warranted. But just speaking in terms of a pure catalyst as to what could trigger something, I think you're looking at something that's potential right here. So that's all I've got, Terry.
All right, Tim, thanks. I just want to circle back to John on that market correction topic. Disregard the recent activity in the market because the market's moving up pretty high at the moment. But some people, John's still talking correction soon. Any thoughts?
I think Tim pointed out the best place to look, which is the financials. Regional bank data, 100% returns in some of these stocks over a year. Just think about it in that terms. It's no problem after 100% move to knock 15 or 20% off these stocks. That's basically what Tim's saying. He's not saying they're going to fall apart, but he is saying, look, valuations on the financials are way stretched relative to how possibly they could perform in this market. And there's no way to see fees and all the other non-interest rate related income that's going to happen to be positive for the banks in terms of lower, default rates, more people paying their bills, more options for loans. All these types of things can't make up for that, at least not for 100% run. And I think Tim's headed in the right direction. The financials are where we can get a 5% correction in this market here in the next quarter, particularly as the Trump issues merge. The only thing I would add to that is, as I pointed out, is that if NAFTA falls apart, if we have a trade war or any kind of escalation of activity, that can tank it too. That's the other place to look for, is not in the tax policy, but into the trade discussions. If those collapse, that would be another source of correction. All
right. Unfortunately, that's all we have time for today. We want to thank our panelists, John Blank and Tim Nyland. Getting their input on various issues is always interesting. Hope you found this informative, and if you have any questions regarding our services, feel free to email them to zrs@zacks.com. Likewise, if you would like to receive a copy of John or Tim's PowerPoint presentation, or both of theirs, featured in today's call, same email address applies, zrs@zacks.com, or you may contact your ZRS representative directly. One programming note to mention, our chief equity strategist, John Blank, is scheduled to be on the closing bell on CNBC today at 4 p.m. Eastern Time this afternoon. In case you're near a television, you may want to check that out. Promises to be a big market discussion when John is involved. In the meantime, thanks for joining us. Feedback is always welcome, and we look forward to the next time we're all together on the call.